Welcome to an in-depth exploration of permanent capital, how private funds are moving beyond the 10-year model. This video will comprehensively detail the rise of permanent capital vehicles, revealing how they are transforming private markets and offering new solutions for both general partners and limited partners. Prepare to delve into the intricacies of this evolving landscape. To truly understand the revolution taking place in private markets, we first need to define what permanent capital is and how it fundamentally contrasts with the traditional private fund model. For decades, the private equity landscape has been dominated by a specific structure, the closed-end 10-year fund. This model, while successful, comes with inherent limitations. The traditional model typically involves raising a fixed pool of capital, investing it over a specific period, and then returning capital to investors, usually within a 10-year lifespan. This has been the industry standard. However, this model forces GPs to exit investments by a specific date, regardless of market conditions, leading to potential value destruction. It also creates constant fundraising pressure and exposes LPs to the J-curve effect, where initial returns are often negative. The market is now seeing a significant shift towards more flexible, longer horizon investment structures. This isn't just a trend. It's a fundamental recalibration driven by evolving investment opportunities and investor needs. So what exactly is permanent capital? At its core, permanent capital refers to investment vehicles that do not have a predetermined liquidation date. Key examples include evergreen funds and perpetual funds. Unlike the traditional 10-year fund, a permanent capital vehicle has no fixed end date. This means the capital can be continuously reinvested, allowing for truly long-term asset management and value creation. These structures come in various forms, from privately held evergreen funds with redemption windows to publicly traded vehicles like business development companies, and even dedicated perpetual private funds established by large asset managers. The objective of permanent capital is to align the investment horizon with the life cycle of the assets being acquired. This makes it ideally suited for long-duration themes such as critical infrastructure, sustainable real estate, and renewable energy projects. Both general partners and limited partners are increasingly embracing the permanent capital model due to a compelling array of benefits that address the limitations of traditional structures. For general partners, permanent capital offers critical advantages. It eliminates the pressure of forced exits, allows for the strategic building of thematic platforms, and ensures a consistent stream of fee income. GPs can avoid the need to sell assets prematurely during market downturns, preserving value. They can also build out long-term, high-conviction thematic platforms, like those focused on the energy transition or global logistics networks, without a looming exit deadline. Crucially, permanent capital vehicles provide a more consistent and predictable management fee income stream, reducing the cyclicality associated with traditional fundraise cycles. This enhanced strategic flexibility and optionality is a game-changer for fund managers. Limited partners also gain significant benefits. These include enhanced liquidity options, the ability to make consistent allocations without timing new vintages, and a significant mitigation of the dreaded J-curve effect. Many permanent capital vehicles offer regular redemption windows, providing LPs with a degree of liquidity previously unavailable in private markets. They also allow LPs to allocate capital consistently, rather than waiting for a new fund vintage to open. Furthermore, the continuous investment and reinvestment within these structures help to smooth out returns and significantly mitigate the initial negative impact of the J-curve, leading to greater portfolio stability and reduced reinvestment risk for LPs. Two of the most prominent permanent capital structures driving this transformation are evergreen funds and publicly traded business development companies, or BDCs. Evergreen funds are experiencing explosive AUM growth, with forecasts reaching $427 billion by mid-2025. Their mechanics involve a continuous flow of capital, constantly being deployed and reinvested. This continuous inflow of capital means fewer demanding fundraising cycles for GPs. Business development companies, or BDCs, are another form. These are listed vehicles that offer retail and institutional investors permanent access to private credit and direct lending strategies, with shares trading on public exchanges. Publicly traded BDCs act as a crucial permanent capital vehicle, allowing broader investor access to private market opportunities, typically in the form of direct lending to middle-market companies, providing consistent dividend income. Let's look at a prime example of a firm successfully leveraging permanent capital: Blackstone. Their strategy demonstrates the power of these structures. Blackstone has been a pioneer, notably through its infrastructure fund, which benefits from a significant perpetual commitment from a major insurance partner. This exemplifies how permanent capital underpins their long-term infrastructure plays. This long-term structure is ideally suited for high-conviction thematic investments that require significant upfront capital and a multi-decade horizon to mature. Think energy transition or digital infrastructure. Blackstone and other firms are leveraging permanent capital for themes like large-scale energy transition projects, the development of vast digital infrastructure networks, and core real assets that demand a patient, multi-decade investment approach to maximize returns. While permanent capital offers significant advantages, it's crucial to acknowledge the challenges and risks associated with these structures. The impermanence of redemptions can lead to liquidity mismatches if not managed carefully. Also, some publicly traded permanent capital vehicles can trade at a discount to their net asset value, NAV. Succession risk within the fund's management team also needs robust planning. It's worth noting how some large asset managers are integrating insurance platforms. These platforms provide a consistent, perpetual stream of capital, which can be deployed into various long-duration private market strategies, further solidifying the permanent capital model. Looking ahead, the trajectory for permanent capital vehicles is clear: continued growth, increased institutional adoption, and an intriguing blurring of the lines between public and private markets. We anticipate sustained growth as more GPs and LPs recognize the strategic benefits. Institutional investors seeking stable long-term exposures will increasingly allocate to these structures, creating a more integrated hybrid financial landscape. Permanent capital is fundamentally transforming private markets, offering a robust solution for long-duration strategies, consistent returns, and enhanced flexibility. While beneficial, remember that all investment decisions carry risk. This content is for educational purposes only and not financial advice. Consult a professional for your specific situation. Thank you for watching.